Welcome back to our year-end webinar series for tax planning. Today I'm joined with Andrew Cook. Andrew is a partner with HHM Wealth, a sister company to the CPAs. Today we're going to be talking about everything retirement plans. So Andrew, if you could just introduce yourself, tell a little bit about what you do here, and then we'll jump right into some of the questions.
Yeah, my name is Andrew Cook. I'm a certified financial planner, and a lot of the work we do is helping individuals and families with their investment management retirement goals. But I also head up the retirement plan advisory business for HHM Wealth. So work closely with company owners and participants on this exact subject.
So just in general, let's go through a rundown of some retirement plan options. Maybe phrase them in employer plans versus maybe some individual plans people can set up on their own.
Yeah. So your general employer plans, you're going to have 401ks or 403bs for hospitals or education. Occasionally you'll see a 457. But the government, with the Secure Act 2.0, is really trying to make those 401ks more accessible and improve the features. So I think we're going to see a lot more of those going forward. On the individual side, you've got your individual IRAs and Roth IRAs. So
let's go into, you mentioned Roth, let's go into traditional versus Roth and kind of the tax differences there. I get that a lot from clients. Should I donate to a traditional or contribute to a traditional, or should I contribute to a Roth?
Yeah, so we love Roth accounts because once you've paid the tax, you never have to pay that tax again. However, you got to kind of look at what your situation is and what your tax bracket is currently and what it might be down the road. So the general rule of thumb is we're trying to defer tax as long as we can. The exception to that would be if I can pay that tax now at a lower rate than I'll ever get to pay again, that's when the Roth comes in. So again, generally it's going to be people who have a lower tax bracket. Maybe your income's off for a year. Retirees have that option even later on to do Roth conversions. Once you start getting into the 22-24% tax bracket, it's hard to pass up that tax deduction in the current year.
Okay, so when it comes to deferring taxes, the IRS isn't going to necessarily probably let us do that to an unlimited extent. So can you get into a little bit of what the plan limits are and help people understand those?
Yeah, I'll start with the employer-sponsored and particularly the 401k. The deferral limit's gone up by $500 this year, so participants can defer up to $23,000 now. For folks that are 50 or older, there's a $7,500 catch-up. So again, it's not a huge increase. We see the same increase in IRAs and Roth. So again, you can contribute in one or the other, or a combination, up to $7,500. Sorry, $7,000. And then there's a $1,000 catch-up. So the catch-ups didn't move, but the base deferral amounts both went up by $500 this year.
Okay, so I know there are situations where people can contribute both to maybe an employer plan and a traditional IRA or Roth. Can you help people understand, though, there are some, let's say, rules written in where you may contribute to an IRA, but it may not be deductible?
Yeah, so if you don't have access to an employer-sponsored plan, there is no limit on deductibility for traditional IRA. The issue comes in is if you have access to a 401k, then all of a sudden there's income thresholds that start phasing you out. It gets a little bit even more complicated when you bring in your spouse. So in a scenario where a spouse does not have a 401k or access to an employer-sponsored plan, their limit is going to be higher. But there is still a limit. So there's a matrix on the IRS website. We can help, any of the advisors at HHM can help determine. And again, it kind of comes down to whether or not you or your spouse have access to a 401k. I do want to mention, my wife doesn't work outside the home, and so she doesn't have traditional income. But we're able to make IRA contributions based on our combined or joint income. And so it's one of those things to look at. But again, those thresholds need to be alert to as far as the deductibility. And there are a few things that maybe like a backdoor Roth or something that could still be applicable. So.
All right, let's switch gears a little bit into maybe the distributions from traditional and maybe Roth IRA plans. Specifically talking about qualified charitable distributions. How can these help people with their RMDs, and how can they maybe think about this as year end with December 31st coming up? What steps they need to take in order to take advantage of those?
Yeah. So the Secure Act and Secure 2.0 have pushed back the starting dates for RMDs. So that now is age 73. For clients or individuals that were already of RMD age, they have to keep taking them. But a couple years ago, the IRS locked in their QCD, Qualified Charitable Distribution rules. And basically, if you're at least 7.5, you can make a direct gift to charity out of your IRA. And it's sad. Not only is it tax free for you and the charity, it satisfies your RMD. So it's kind of a win-win. And to say that a different way is if you were planning on making a gift to a charity and you took an IRA distribution and had to pay tax, that's less money that you could give the charity. Whereas if you go directly from your IRA to that charity, then there's no tax consequence. So again, the key is you have to be at least 7.5 to be able to do that. But that's a really nice way. Also want to mention that you can't do that about a 401k. It's got to be IRA, so that comes up from time to time. And again, generally at that age, you can do an in-service distribution, or you can do something else to meet those qualified charitable distribution rules. So,
with December 31st coming up, let's just kind of finish on what do people need to know for employer plans? How do they need to be funded, and when do they need to be funded by? And then maybe also kind of talk a little bit about how that's a little different for traditional IRAs and Roths.
Yeah, so almost all employer plans are going to insist or kind of hold you to payroll deductions to fund your employer-sponsored plan. So really that deadline's coming up pretty quick as of 12/31. The nice thing is that with your individual IRA or Roth IRA, you actually have up until the filing deadline, April 15th or thereabouts, to make those contributions. So you do have a little bit of time, and you'll kind of know what your income is, and again, hopefully can look at a draft return or something to determine whether or not you're still eligible for those contributions. So.
Awesome. Thank you so much. There's a lot of, I know, AGI thresholds and different limits we talked about. You can look at our website, www.hhmcpas, and we have some resources on there. If anything we said today maybe spurred any questions, you can also feel free to reach out to us. HHM Wealth has several advisors that can maybe answer any questions.